Right, so unless you think the market's not going to ever be above, whatever our peak was in earlier 2018, it's going to make some sense to be invested. Look, we are pretty optimistic about 2019. Some of the reasons you said, some of those technical indicators are just they're more games with numbers, I think. But look, after you've had a double-digit quarter, and I think our friends at Bespoke actually came up with this idea. If you have a double-digit quarter, there's been 19 times we've had that since World War II. From that, a
double-digit down quarter.
Correct, double-digit down quarter, sorry. Yeah. 13 of the 19 have been up double digits the next year. Most of those are over 20%. The median's quite high. There have been 4 flat ones and 2 basically that were down another double digit. So very seldom do you get a follow through in this. Look, most importantly, bear markets and huge negative catastrophes like 2008 don't happen when the economy is in decent shape. Clearly, we've come off the boil, to use a phrase. Clearly, things aren't as strong as they were looking last summer and last fall. But we certainly don't think it's Armageddon. We think the market's gotten really cheap. The good valuations here. That's the basic gist of our story.
Let me turn to Bill Stone and get your reaction to what Mike just said and what your overall thought about 2019 versus 2018 will be. If we're not in a bear market, let me pose the question a different way. Is the bull market dead? Bill?
I don't think it is. I think it's similarly, we did some interesting analysis, not exactly the way down the quarter, but just said, hey, when you were down close to 20%, did it make sense to buy in again? I mean, obviously we know the history, it does, but also looked at it in terms of whether we ended up going into recession or not. Honestly, in the end, it doesn't matter. You actually end up in a good place over 3 years. Certainly over 1 year, you're in a better place and you have significantly better returns over the following year if you weren't in recession. But either way, it gets to the same point, which is there's reasons to be a bit more optimistic this year. I do think you're going to see, much of what we just talked about, which is you're going to see the economy slow a bit. We're thinking, something in about the 2.25% pace for GDP here in the U.S. versus over 3% for last year. We think earnings are going to slow down to somewhere around 5%. I think we'll probably beat that. But it's still a good backdrop. Again, not as good, but in terms of a good backdrop. And certainly stocks got cheaper last year because earnings were up probably over 20% last year. So, if you're looking for a spot to start buying, I do think it's a place to look.
So, Bill, you don't see a recession coming. What happens if China keeps slowing?
Yeah, I don't see a recession certainly this year yet. You do have to worry. Obviously, China and the whole trade issue is I'll call it a wild card. China in and of itself, I think, they're going to start, and you've already heard some of it, will continue to pump some stimulus in there. So I guess I'm not as worried that China in and of itself will turn around. The trade is always hard. I think we'll get to a deal, but that one is a little bit out of any of our hands, right? But I think the interesting part is the U.S. can, in fact, diverge from the rest of the world and continue to grow, albeit it becomes a headwind if the rest of the world's having trouble. That's not necessarily true of other parts of the world. So I do think it's worth keeping that in mind when you're thinking about things.
Quick final thought, Mike. What sector do you like most for 2019, and what would you avoid? Quick.
Oh, I think avoid utilities, avoid really, the deflationary game. They're very expensive and they remain expensive. They're underperforming today. I'd probably be interested in technology and financials if I had to pick 2 out of whatever the 10 or 11 are.